If you have any questions during this presentation, don't hesitate to put them into the chat. We do have a team ready on standby to respond. Today, we're going to begin our call with our Senior Advisor to the Associate Administrator, Mr. Jamie Inslee. Jamie, the floor is yours.
Good afternoon, and thank you all for joining the 504 Quarterly Connect Call. Thomas Kimsley is traveling today, so I'll be leading the discussion. We have a full agenda and many exciting updates to share. You'll be hearing from several of our directors and
Jamie
their teams,
Inslee,
including our new Director of OFA, Dan Pichet, who has some great announcements from his team, updates from OFPO and OPSM with timely program insights, and we've also invited OGC to introduce their new team leads. Update on our 504 modernization initiative. One of the biggest developments this quarter is the 504 modernization initiative. Earlier this year, we requested feedback from lenders and CDCs, and we heard you. And we've taken that input seriously. Using your feedback, we've developed a modernization work plan designed to make the program more efficient and responsive to business needs. Now, some elements will require legislative changes, but many do not. And we've already started implementing improvements over the summer. Dan will be sharing more details about those efforts in just a minute. Let's see, I've got the slide up, okay. I'd like to kick off today's discussion with good news about the growth in the 504 portfolio. Overall portfolio performance, total approvals, 2025 approvals are a little over $7 billion. 16% increase over the prior year. Number of loans, 6,165 loans approved, up 12.2%. The average loan size is about 1.2 million, indicating slightly larger deal sizes compared to some previous years. Jobs supported, 65,700 jobs supported, reflecting strong economic impact. Loan approvals show steady growth since 2020. The approval amount trend line indicates that SBA 504 program continues to be a critical financing tool for small businesses, particularly in recovery years. If we look at the segment analysis there, some good news there too. On the rural lending, it's up 7%. Veteran-owned businesses is up 7%. One thing to note is women-owned businesses, that was 921 loans, up 13%, and they had 801 million. It's the largest growth rate out of the group, up 21% in dollars. Manufacturing, 488 loans, it's down 3%, but it's up 15% in dollars. Fewer projects, but larger scale financing. I think some takeaways here is we have strong growth momentum. The SBA 504 program is seeing double-digit growth in both loan count and dollars, driven largely by mid-range loans, rural expansion, and women-owned businesses. Shift in deal sizes. Very few small loans, but larger manufacturing projects are boosting average loan size. Of course, job creation, over 65,000 jobs supported, reinforcing the SBA 504's role in economic growth and workforce development. Overall, 2025 activity for the 504 loan program reflects strong momentum with 16% growth in approvals and significant contributions to job creation, and we are grateful for that. Next up, Dan Pichet, our new Director of Office of Financial Assistance. Now over to you, Dan.
Jamie, thank you. And thank you all for taking time out of your day to join us here. For those I haven't had a chance to meet, my name is Dan Pichet. I'm the new Director of the Office of Financial Assistance. I came on board at the end of June, so I just missed the last 504 Connect call, although I was in the audience for that one. On the next slide, as Jamie teed up at the top of the call, I have a couple updates. Just wanted to go over, as Jamie mentioned, the 504 modernization effort is ongoing. Really going to be kind of a multi-phase plan, but we are working on an update to SOP 5010-8 to issue some modifications based on the feedback that we've received from our lenders and our stakeholders. This will be previewed here and discussed in greater detail once it is through the clearance process. But in short, what we're looking at is identifying areas where we can remove some friction that our lenders and CDC partners experience during their use of both 504 and 7A. And I think this will be a really good round of updates that is really driven by industry. So for all of you who we interact with at conferences or with some of the questions that you have, know that the feedback that you give us is really critical to us making changes to the program. We need to learn from the experiences that you have working with your small business clients and areas where we can make program improvements. So please continue to send in feedback or areas that we can work to improve. In terms of our fees, they were published at the end of August, and both for 7A and 504, they did contain the first ever targeted fee relief for the manufacturing sector. So within the 504 program, that is a waiver of the upfront and servicing fee on loans to manufacturers. Within the 7A program, a waiver of the upfront fee for loans at or below $950,000. Some of our lenders have received questions related to the debanking effort or the debanking rule. Know that we have an inbox set up and some more guidance in process, and all those questions can be sent to debanking@sba.gov. The SBA Administrator Leffler did announce a new regional innovation cluster, which provided $7.5 million in new financing to support the manufacturing sector. And that dovetails into my last point, which some of you may have heard that the 7A chief, Ginger Allen, has left the agency recently. And I am excited to introduce Bob Carpenter, whom many of you know as our acting chief. And he's going to give a quick intro into the MARC program, which is another effort that the SBA is putting in place to help support the Made in America Manufacturing Initiative and ultimately outfit our suite of loan products to help you meet the needs of your clients. So thank you again for your time. Bob, I'll pass it on to you and let's take it from there. Thank you.
All right, Dan. Thank you. Just saying hi. This is Bob Carpenter. Most of you who've been around for longer than a minute know who I am. I am now acting for the 7A chief position until my pending retirement, I guess, or maybe even before then, but until they fill the seat that I'm just keeping warm. But right now, any questions for 7A that you may have, forward those on to me, and I can help you with those. The 7A Manufacturers Access to Revolving Credit Program is about to roll out, and Dan and the 7A team will be putting together a training presentation on Friday, 2 o'clock. So if you have not received an invitation, I believe a mail blast was sent out earlier this week. I just received confirmation from my team that the mail blast did go out and was delivered. So you should have received something from the SBA OCA notifications page about that training and a link to sign up for it to get into the training on Friday. We'll go over in more detail the MARC program and some of the differences that you have and how that MARC program can fit in your quiver of arrows for providing capital to your small businesses that are manufacturers. So not just those of you who are 7A lenders, but your 504 lenders need to be aware of this as well, because you'll be making loans and 504 deals to your manufacturers who may also need at the same time some working capital financing. And the MARC loan program is a great tool for those types of businesses to continue their marketing efforts. So just wanted to quick say hello there, and I want to thank the 504 team for giving me a couple of minutes on the soapbox to shout this out and reintroduce myself to those of you who may have forgotten me or remember me with long hair, things like that. So thanks, and I'll turn it back over to Linda.
Hi, thanks, Bob. And we're excited to have Bob in that role. Bob and I had that role before when he was acting, and we have worked wonderfully well over the years as a team. And we look forward to having Bob back in that slot so we can continue to work together. And one thing that Bob should also mention is that when you're sequencing your 7A and your 504, maximize your 7A first, because 504 doesn't have the cap for manufacturing and 7A does. So one more thing to keep in mind. So I want to give a shout out to the people who put this together. Jerome Gray does a wonderful job as moderator and all the technical stuff that he does. Greg Siriati is the person who pulls all the presenters together and helps us create the deck and does the follow-up and the Q&A. So I want to thank everybody for that. So a couple of exciting things that have happened. As Dan said, we published, and I have a typo, sorry, for the first time ever, a waiver on manufacturing for the 504 program. There have been different waivers over the years for 7A, and we've always been asked, why don't we do more waivers for 504? So this is a first-time effort. We hope that it will drive volume. We hope that the borrowers will really receive a benefit from this fee waivers. And one way that we can offer fee waivers is when the 504 program is robust and is growing. So Wayne has said more than once, how can we adjust fees? Give us another surge like you did during COVID. The more loans you do, the more opportunities we have for future fee waivers. So thank you for the work that you've done this year. And we have the debenture funding calendar has been published, and Glenn Duran will be on in a little bit from Eagle Compliance to talk to us more about market expectations. We do have a lot of expectations on where's the new 4 and 1244, and it is in clearance pending the citizenship notice, and that will remain that way for a while. The 5056 notice is also in clearance, but in the meantime, until that publishes, the ALP Express Guide's fine. The environmental review notice that we put out on guidance is fine. So the guidance is out there. It's just that those will all eventually get folded into 5056. And Nermeen will do more training on that in the December call. Also, too, on the December call, we'll have SOP 5055, which is in clearance. The servicing team has incorporated all of ALP Express. So once both of those SOPs get published, we'll no longer need the guide. It'll all be an SOP, but there's a whole lot of other really great creative solutions that are coming out in 5055, and they're finishing up the clearance on that now. So June and his team will be publishing that sometime this fall and training on that, most probably on the Connect call in December. So for tomorrow, we have the environmental review training, that notice that we put out in March. Steve O'Leary and his team, and Steve will chat with you a little bit about what's coming up tomorrow during his update. We're very excited. They put a lot of effort into that. We encourage every CDC out there, be on the environmental call. Yes, it will be recorded and you'll be able to have access to the recording, but you have that one chance to ask live questions, and that's when they're live. So please make it a priority and be at the training if at all possible. The PIA team will not be on today's call, but had a very important announcement that some people heard, some people didn't. So we're going to talk about that for them. The PIA team is now notifying the third-party lender at the same time that they notify the CDC. So, just be aware that that's happening. It's already in place. And so we've gotten really positive feedback from the third-party lender that they're getting that notification and that they can work as a team with the CDC to help resolve and mitigate any outstanding PIA issues. They said we'd much rather be part of the solution than get an unwanted surprise. So we're very happy to our third-party lenders for being so proactive and working with us with addressing any outstanding PIAs. And we want to thank all those CDCs that have taken this process very seriously and are working with us hand in glove to resolve any outstanding PIA issues. So we have interest, news today, and I want to, kind of tee it up, but let Glenn give us the update. We're very excited that there's some news that's coming about. You've heard it in the news, but you're going to hear it from us here today about where interest rates forecast to go. So more on that in just a moment. So now we're going to introduce, if you'll come on camera, Glenn Duran is representing Eagle Compliance. Frank had a conflict today, but Glenn is going to come on, give us the market update, and tell us what's going on with interest rates. Over to you, Glenn.
Wonderful. Thank you, Linda. And Greg or Jerome, if we could go to the next slide, that would be great. Perfect. Thank you. Good afternoon, everyone. On behalf of Eagle Compliance, thank you for the opportunity to provide this update. For those of you that are unfamiliar with us, between myself and Frank Keene, we act as your fiscal and selling agent, work between the SBA and Wall Street, if you will, in managing your debenture issuance and pricing process. The chart before you depicts the 504 loan origination volume over the last 6 years. Happy to report, as Jamie Ensley alluded to a little bit earlier ago, that the program is as popular as ever. This chart is a bit dated. We only got the September debenture offering numbers this morning. Today happens to be announcement date for the September offerings, and they are larger than we've seen in quite a while. The total issuance number between the 10-year, 20-year, and 25-year that we're bringing to market this Thursday is 614 million. Largest offering we've had since November of 2022. And I think Linda said to me, second largest offering we've had in the history of the program. So if we adjusted these numbers, the year-to-date issuance, the fiscal year total issuance for the SBA 504 program would be a smidge over 5.7 billion. And that's up from 5 billion in the year 2024, or a 14% increase. I think this is particularly impressive as debenture rates have not fallen dramatically. So it's not a big refinance initiative. Only 10% of the issuance that we brought to market this year has been represented by refinances. So it's an impressive growth number for the program in a relatively stable interest rate environment. As we've talked about before, about 95% of the loans that are being originated, the debentures that are being sold, are in the 25-year sector. If we could move on to the next chart, please. Sometimes at conferences, sometimes on calls like that, we at Eagle Compliance are asked about the direction of interest rate or the direction of spreads of our debt issuance relative to Treasury. And the truth of the matter is we actually don't know. Not for sure, but there are tools that you can look to for guidance. One of those tools is the CME, the Chicago Mercantile Exchange Fed Watch tool. And it assigns a market-based probability that the Fed will be changing the targeted Fed funds rate. So what are the odds? What's the probability that next week on September 17th, the Federal Reserve will reduce the targeted Fed funds rate? And like the chart before, no, let me get into it for just a second. As you know, the Fed maintains a dual mandate. Their goal is to manage towards full employment, to maintain price stability. As you also probably know, last Friday's employment report was disappointing once again. It was the third month in a row that the numbers came out and they were below expectations. In 2025, if you look from May to August, the number of jobs that were created on average was about 27,000 per month. If you looked at January through April of last year, that's the beginning of the year, we were averaging about 123,000 jobs. So some weakness, significant weakness, is clearly being displayed in the labor market. Like my first chart, this chart is also dated as of last Friday. But again, like the first chart, kind of dated in a good way. I gave you two tables, two charts, if you will, that represented 2 weeks ago the meeting dates when the probability of the Fed decreasing rates was greater than 50%. Greater than 50% probability that they were going to decrease rates. Happy to report after the employment report on Friday, the disappointing report, that that chart today would contain three different tables, because the Fed is now expected to reduce rates by 25 basis points in September, October, and December. And the probabilities have gone up. This has led to a significant rally in Treasury rates. The 5-year Treasury rate this morning was 3.58%. That's down 37, almost 40 basis points since the last time we brought a 10-year SBA debenture to market, which was in July. The 10-year note this morning was at 4.06. We're down 16 basis points from last month when we last issued our 20 and 25 year. PPI and CPI will be released this week. They're important numbers, as always. However, I think unless they are extraordinarily bad, it's not likely to change the trajectory of the market or the trajectory, if you will, pardon me, of the Fed's movements next week. If we could go to the next slide, please. This chart shows you the federal funds rate in the red line and the 10-year U.S. Treasury yield. And I put it in here just as a reminder that even though the Fed funds rate declines sometimes, term rates don't necessarily follow. In September of 24, as you can see on the chart, the Fed began a series of 3 interest rate decreases, and term rates, the 10-year in this case, actually moved from 375 to 480. So it's not a guarantee that the Fed, if they do something next week, and then again in October, and then again in December, that we're going to see a decline in term rates, though that does seem to be the direction the market's leaning in at this particular point in time. There are other factors like fiscal policy, like the amount of Treasury debt outstanding, like the amount of Treasury debt outstanding relative to GDP, and finally, where, and when I say where, I mean what part of the Treasury curve that debt is being issued at, forgive the grammar, what part of the curve, is it 2-year debt, 5-year debt, 10-year, or 30-year debt that the Treasury is issuing the most of, if you will. Final chart, second to last chart, please. Thank you. I mentioned earlier, we are in the middle of a 3-part sale. You are bringing to market this month a 20-year, a 10-year, a 20-year, and a 25-year, 20 million of the 10-year, 18 million of the 20-year, and 577 million of the 25-year. The spreads that we talked about this morning to investors through our underwriters were 55 on the 10, 68 on the 20-year, and 73 on the 25-year. These are all across the board the same spreads that we used the last time we brought these issues to market. There have been some positive factors in the market, including the shape of the curve, the relative value of our issuance relative to some mortgage-backed securities issuance out there. However, there are some other things going on. This is a pretty big deal for us. Larger size, more bonds for the street for investors to digest. Next week, I can't tell you exactly when because it's kind of a secret, the SBIC is expected to come to market with their semi-annual issuance also. And for natural reasons, it's a very similar credit, and people expect them to be coming to market with about $1.5 billion in size. And finally, the drop in Treasury rates, although it's good to see, it's tough for investors to absorb both the drop in rates and then a tightening in spreads. So we went out those 55, 68, and 73 levels this week. Speaking with the underwriters just about a half an hour ago, they are well done on the 10-year and done on the 20-year and the 25-year. So if the market holds up between now and next Thursday, and that's a big if, our spreads will not narrow. We'll price exactly where we did around the last time around. However, our borrowers' cost of funds will be significantly lower to the tune of 37-ish basis points on the 10-year and about 15 or 16 on the 20-year and on the 25-year. So all things considered, not so bad. Final slide, please. This chart depicts prepayments of both the acceleration and the voluntary form for SBA 504 loans. Our investor interest in this chart is primarily focused on how prepayments of either form affect the weighted average life of SBA debentures, 504 debentures. The blue line, accelerations at the very bottom, love having it down at the bottom, has thankfully remained static and low with an annual rate of 0.51%. The red line is prepayments, which typically inversely track the path of debenture rates. If debenture rates go up, prepayments decline. If debenture rates go down, as you would expect, people will take the opportunity to refinance. The 25-year debenture rate most recently peaked at 5.82 in October of 23. Prepayments, as you see, began to decline after that from around 362 million at their highest in September of 22 to their lowest of 68 million in July of 24. If the Fed, and as the Fed, I go so far as to say, as the Fed begins cutting rates next month, this month, and the month after, with any luck, the size of the cuts will impact Treasury rates, SBA rates, debenture rates, mortgage rates, and likely offer increased refinance opportunities. That concludes our comments at this point. Thank you again for the opportunity. Most appreciated.
Thank you, Glenn. That was very good information. Next up, we have the Office of General Counsel, and our guest will be Steve O'Leary.
Great. Thank you so much for having me. I just wanted to do some updates really quickly. So first of all, just a reminder about the training. As Linda mentioned, we are going to do environmental training tomorrow. So it's going to be the environmental team, Eric Adams, Kelly Acock, myself, and Zane. We're going to do some training on the environmental process. So it should be really good, and you can answer some or ask some questions, and hopefully we'll touch on a number of issues. So just a reminder about that. And then I just wanted to touch base on some franchise issues. We get a lot of questions in the box about the process or what the directory looks like. And just for everyone, we've added close to 225 brands since we started, new brands. We have received over 500 new brands in our queue, and we're moving those as quickly as possible. So we really appreciate your patience as we move through that process. Just a question that we get a lot is the way the design of the directory. Right now, we're in a transition period on the directory. I think most of you realize we're moving from an addendum process to a certification process. But since we are over 8,000 brands currently on our directory, that can't happen overnight. So we are moving in steps to make that happen. So if you see a brand on the directory and there is a Y in the franchisor certification box, that means that franchise system has given us a certification. Those addendum boxes then will become blank at that point. And so I think that's seems to have confused a lot of folks as to what to do about an addendum. So just to be really clear again, if those addendum boxes are blank and there's a Y in the franchisor certification box, that means that the franchisor has provided that certification and the addendum is no longer required. So from a lending perspective, you can move forward knowing that the brand meets our requirements, and you just need to follow those notes in the notes column in there. If the brand is on the directory and it doesn't have a certification, that doesn't mean it's not eligible. It means it is still eligible. It remains eligible, but they have not submitted the certification, or we have not processed that certification. Again, just as a reminder, there's over 8,000 brands on the directory. We have certifications that we have not processed through because we are trying to prioritize the new brands coming onto the directory. So the fact that the certification is not updated has no negative effects on the brand. It just means that we have not processed it through, or they may not have submitted it yet. So just to clarify that. Also, as we are moving through this process, we are finding franchisors changing their names or amending their names. So you may see situations where a franchisor has more than one name on their brand. And that could be because either they've modified their name and we're keeping the old and the new, or they've actually changed their name. So again, you may see just a little bit of that in there. As long as the name matches the brand that the franchise agreement represents, you should be fine. So even though there's 2 or 3 names on there, that's perfectly fine. And then there are those brands that are multiple franchise brands on either one FDD or one franchise agreement, and those also may have multiple names in there as well. So just be aware that things may look just a slightly bit different from that perspective on there in terms of how that directory is looking. We get the question of how much are we updating? I am trying to update at least once a week. If I can get it updated twice a week, I'm trying to do that as well. Again, it goes through a process. Once we get the updates to submit to our IT team, they have to code the new brands, and then the directory has to be posted. So it doesn't happen simultaneously, but I am trying to do it at least once a week. If we can do it twice a week, then I'm trying to do it twice a week. So just an update on that. And then the last thing I want to talk about, probably the most number of questions we get on the topic is, what is our turn time? And I am trying to get us to 10 to 15 business days. We aren't there yet, but we're getting there. Our volume has started to level off just a bit. We were at the height of the directory coming back upwards of 150 to 200 emails a day in our box. We are coming back to a more reasonable amount of emails in the box, and we are trying to get ourselves under the 10 to 15 business day mark, which is where we would like to be. We still are cleaning up a lot of older submissions, but we are trying to move towards that mark. So just so everybody knows, we're not there yet, but we're getting there, and we're working really hard so that we can get there. So I think that's all I have. So I will go ahead and pass it. Am I passing it to Tony? I think, Tony, you're up next.
Yes, thanks, Steve. Hi, everyone. Good afternoon. Linda asked myself and Michelle to join this call today to introduce ourselves as new team leads within OGC. So I'm Tony. I go by Tony. My name's Anthony Arroyo, and I'm district counsel in the Philadelphia district office, which is actually in King of Prussia, Pennsylvania. Many of you might likely worked with Bill Gary, my predecessor in this historic property role with OGC. And I had the chance to work with Bill Gary on historic property review for my years as district counsel, but also he was very generous in making time to transition many of his files and many of his experiences to me. So to the extent that I can in this role, basically, I just wanted to introduce myself. I've been with SBA for about 15 years, and I look forward to working with you all on Section 106. So if you hear that term, what that is that's a historic property review. And I have already discussed with Linda, and we look forward to providing trainings on the Section 106 historic property review process. If between now and then you do have questions that arise, or you come upon a property that has some historic issues, I would guide you first to the SOP 5010-8 at page 96. To the historic property review section. And second, I advise you to reach out to your district counsel, who will be usually your first submission your first submission for a Section 106 review is going to be your district counsel. And I will work with all of your district counsel as well on these reviews. And to the extent that you do have any other questions, feel free to reach out to me as well. And with that, I will pass to my colleague, Michelle. Thank you.
Thank you, Tony. Hi, everyone. I'm Michelle Cheesebro. I'm currently Minnesota District Counsel. My time with the agency, I've been with SBA for about 10 years now. And initially, my experience with the 504 loan program was on the back end, where I handled litigation, 504 litigation for Iowa and Missouri, and overflow litigation for Illinois and Wisconsin. Then when I started doing loan closings, initially I was covering Iowa and part of Illinois, and then moved on to now I'm handling all 504 loan closings and litigation for Minnesota. I've also interacted with quite a few of you through complete file reviews. So please feel free to reach out if you have any questions, and I look forward to working with all of you. Thank you.
Thank you, Michelle. So now we'll turn it over to the Office of Performance Systems Management, also known as OPSM, and that will be Zane Doolin.
Hello, good afternoon, everybody. I'm Zane Doolin, a program analyst here in OPSM, and I'm going to go through just a few updates on some 504 E-Tran cabs. So what we have here up on the screen is the SBA 504 funding module that went live back on August 14th. So we just want to give a big thank you to all the CDCs. I think we had 114 that submitted funding packages for this new module. And we had about 567 loans reviewed and processed by the CSA for about 615 million in total funding. So with this new module, it should be easier now to track alerts for CDCs and any other issues as well. And some of the biggest volume funding alerts that we saw was the debenture note terms discrepancies, ACH form discrepancies, and W-9, IRS form W-9 borrower name discrepancies. So thanks again for everyone that submitted those funding packages. So we just want to go through, inform CDCs about a known error that's currently being triggered within E-Tran. Our team is working towards a resolution, and in about 2 weeks, we should have that resolution in. However, in the interim, if you encounter any of these validations like 332 or 333, which is up on the screen there of what it would look like, please email us and our team at Cavs Questions, and we'll work to solve the error. Again, this will be solved in the 2 weeks' time. This page is simply just for awareness to CDCs. And so just some data entry tips here that we have, some tenants in common as an EPC. So we've seen several applications with tenants in common as the EPC. And the question we've normally been asked is, how do you properly reflect this in E-Tran so that the risk mitigation framework captures all the entities? The answer is shown on the screen here. So you would list the tenants in common within the borrower's menu there on the right-hand side. And in this example, the tenants in common as the EPC are Death Star Enterprises, Inc., Falcon Enterprises, Inc., and DSE, LLC. The operating company, if it's not a co-borrower, would be listed in the guarantors menu, as you see there on the bottom, and as the operating company and the guarantor under Marauder Repairs, Inc. And with that, that is kind of the big updates we have for E-Tran and Cavs. And I'll go ahead and pass it over to OFPO and Peter Paulson and Joel Steiner.
Thank you, Zane. So next up, we have Peter Paulson of the Sacramento Loan Processing Center.
Thank you, Zane. Good afternoon, everyone. I wanted to take a quick look at the deficiency reports for fiscal year 24 and 25, that is first 11 months. I know many of you are familiar with the deficiency report, but we have added a considerable amount of data to it. You know, as the initial deficiency report only showed our interactions with the CDCs based on the first submission, but we all know that some of the loans take a little longer than just a first review and an approval. So if we look at the initial application volume for the first 11 months of 24, it was 5,664 loans. Of those, 4,243 got the first time approval. What that means is, although we're looking at a contact rate of about 64%, that includes phone calls and emails, the first time approval excludes those. And that is, if they did not receive a screen out or a decline, even though we contacted the CDCs on some minor issues, they were considered to be a first-time approval. Now, what comes from that is obviously there's a significant number of loans that didn't meet the first-time approval, but 1,634 of those were either screened out or declined. Now, that doesn't mean that they necessarily got approved on the next resubmission. So as we can see, the table below, it sort of shows that number of these loans got screened out or declined more than once. So the total decisions on roughly 5,600 applications were around 7,300 decisions. As we look towards the industry report itself, the biggest numbers we all have been looking at throughout the years have been the refinancing numbers. Now, there's probably a few reasons for that being that high, primarily being that the loan volume is relatively low. So it's difficult to sort of get the expertise necessary to send in these loans in a complete package. There's also the differences between the debt refinancing with and without expansion that sometimes creates some confusion. But below that, we're looking at the credit itself, and I'm sort of surprised, and I see this also in the next fiscal year that is 25, that the credit analysis should not be much higher than under the regular 504 program, because credit analysis is sort of independent of the type of loan that we're getting in. But I also wanted to note that we're also looking towards the loan modifications and the decisions that are made there. And as we can see in first 11 months of 24, roughly 16% of the 327s that were submitted to us were declined, so they needed some sort of correction or updates. Next slide, please. Now, both Dan and Glenn and others have talked about the significant increase in the loan volume year over year, and we certainly have felt that here at the SLPC. The initial loan applications for the first 11 months were 6,400. Of those, we sent out in the first time approvals of 4,400, 61. However, the resubmissions or the declines in screen notes went up year over year in percentage terms, with 2,182 and total decisions of 8,582. And also, I wanted to go back to the debt refinancing. These numbers still are stubbornly high year over year. But like I said before, again, the credit analysis should not have that big of a spread between regular 504s and refinancing deals. Next slide, please. Now, the initial loan volume, or just number of loans that have come up, is 13% year over year. If we compare the fiscal year 24 versus 25, the percentage of initial loan applications submitted in fiscal year 24 was 76.3%. This unfortunately has dropped now to 69.7%, and in 25, number of total resubmissions as a percentage of the initial submissions is 34.1%. In layman's terms, what does that really mean? It means that our loan officers here at the SLPC are finding more issues with the files, issues that rise to the level where we have to either screen them out or decline them, so we're getting more resubmissions. That, on top of the increased loan volume and the changes we had in our staffing, it's been hitting us pretty hard. So, and the net increase relative to the number of loan applications is in resubmissions is 5.3%. So this is what this leads to, is the increased turn times. Potentially, we will see higher rates when it comes to defaults or improper payments down the road. It may affect the CDC's SMART score. So we are here to try to weed out all these issues and try to, when we come down to signing off on a loan, that they're both eligible as well as creditworthy. Now, I did mention on both previous slides the issues with the credit analysis on debt refinancing loans. Like I said, it really shouldn't be that much of a difference between a credit analysis on regular versus a refinancing loan. But what we have been seeing lately is number of loan applications that really have a lot of red flags. We see that the existing bank loan that is being refinanced has been modified, where they're deferring or capitalizing interest expenses, or if it's interest only. There's a re-amortization of the loan, all pointing towards, weak ability of the borrower to make the repayments on the original note. And, that technically makes them eligible from that standpoint. However, when you're seeing these types of things in forbearance agreements, these are serious issues that we take a look at. And it's really the analysts that are underwriting these loans, they really have to look towards those and actually address them. Because we will notice it and we will, try to figure out then what has been done then to mitigate those issues where we're looking, when you have 2 or 3 years of, debt service coverage below 1, and the only reason that we're really making it is because of the loan modification. And then we are looking towards, some sort of projections. It doesn't necessarily make a whole lot of sense, as refinancing a loan by itself doesn't increase revenue streams and profitability necessarily going forward. So, like I said, we're seeing a number of these loans, and I'm hoping that the underwriters, they take a little extra time to look through them and see what's going on with the company and address those issues, prior to submitting those files to us. And I also wanted to just briefly mention about the INS or the DHS, immigration clearances. That number has gone up significantly with the executive order only allowing naturalized or national citizens and nationals, as well as 10-year green card holders, to obtain an SBA loan. We here at SLPC do that processing both for the 504 as well as the 7A program. So the volume is quite high. And unfortunately, a couple of weeks ago, the DHS website went down for a couple of days, which set us back. But we have been throwing additional resources at this, and throughout the remainder of this fiscal year, we are putting a significant effort in trying to reduce the turn time, which is, as of this morning, was about 8 business days. So with that, I'll hand it over to Joel. Thank you.
Thank you, Peter. During our previous 504 Connect call, we had the opportunity to discuss the unification of the 2 commercial loan service centers, and I'd like to give you an update on the progress that we are making. Understanding the risks presented by combining 2 large operations, we have been closely monitoring a collection of key numerical data related to operational performance and workload metrics. This daily oversight has included statistics such as workload figures, including PPP workload, the type of actions we are processing, the turnaround times in business days, and the percentages related to processing efficiency and quality control reviews that we are subject to. We continue to closely monitor this internal data, and I'm happy to share that with just a few exceptions, work is being performed well within the timeframes established by SBA's rules and regulations. I'd like to share a personal story with you, if I may. A couple of weeks ago, my wife purchased a new fire table for our patio. Now, I won't mention the seller because this story really is not about Pottery Barn, but when she placed the order, she was told that the fire table would arrive by Tuesday, September the 9th. Then about a day later, she received another email telling her good news. The table would be delivered by August the 23rd. We were both thrilled. Since August the 23rd, she has been receiving regular updates explaining why the table's delivery, sadly, has not occurred. This story is not this story is about expectation management. I want to encourage all CDCs to continue to rely on the timeframes in the SOP and in Title 13 of the Code of Federal Regulations as you plan your work and as you interact with your valued borrowers. According to our SOP and CFR, SBA should respond to a CDC's request for approval of a proposed loan action within 15 business days. I can tell you that that type of planning and expectation management will rarely disappoint. And in those situations where there is a bona fide need to push a CDC's
I think we lost connection with Fresno.
Okay. Then,
Is John Gossett on the line?
Yes, Greg, I'm on the line.
Okay, go ahead, John.
All right, well, we'll just jump right into this, and if we could just kind of advance to some slides here. I'm John Gossett. I'm the Assistant Center Director for Servicing here out of Fresno. And just as a reminder, what we're doing is we're not just doing 504 loans, we're doing 7A lending, and I tell servicing, and I tell the staff here, we are not only broad, but we are deep in knowledge and the requirements. And we can actually look at that in here because here are the regulations that we fall under. And by the way, it's not just the 5010 of 5010-8, but it's all the 5010 in effect at the time of loan approval. So when you look at a 5055, the standard operating procedure for servicing for a 504 loan, we're going to have to go back and review 5010s, maybe even all the way back to 5010-4. What's the maximum term? 300 months or 25 years. So we actually have to go way back to things like that. Now we have updated 5057 and 5055s on the way. You've heard that already. Let's go to the next slide here. Now think in terms of time and efficiency and that kind of thing. And we've got a couple of ways to submit actions into the SBA, uploading things securely. Number one is through E-Tran. You can upload that directly into E-Tran. You're probably already doing that in origination when you're uploading documents into E-Tran for the SLPC or the Loan Guarantee Process Center on 7A loans. And there's a way to do that, and that's one of the ways that I would suggest to do. The other way, let's go on to the next one, is you could use Box. And when you go to Box, here's how to find Box. The thing to remember about Box, and let's go ahead and go to the next slide here. The thing to remember about both of these is what we're uploading, okay? Is it appropriate? What do we need? Is there an outline of the request? Do you have your contact information in there? You can't believe how many things we get, and there's no phone number or return email, okay? Also, if there's a document, is there a return label? What have we done with our PDFs? Have we named our PDFs? Or do we just scan them in and send them to the SBA with Xerox in numbers or whatever, right? And also, please put the loan number in the document. So what do I have as an example or as a suggestion if I want to help make things move along faster? The first thing is when I'm uploading a request to the SBA, I want to make sure I have an outline or a summary. Okay, so what would be included in that summary? Just real quick, loan to value, what it is, subordination, assumption, release of guarantor, whatever that is. Right off the bat, let us know what that is. Also, what kind of information would we want to know up front instead of trying to read through a 37-page credit memo? Let's look at our financial analysis. If you could put a quick financial analysis in there, debt service coverage last couple of years. How about collateral analysis? What's my liquidated loan to value and my loan to value? When was my appraisal done? The date of that appraisal, that would be nice to have. Also, if we're messing with the guarantors, how about a guarantor analysis, net worth, that kind of thing? of all the guarantors. If I'm going to release somebody, it'd be nice to know what the net worth of that person is on an updated financial statement. But also everybody else, think in terms of what is appropriate. Why was the decision made? Am I releasing the strongest person? Is that the person that the decision was made on this loan? So think about financial analysis, collateral analysis, and then a guarantor analysis, okay? Now, I did mention something about lack of contact information. So one of the things that you would really want to look at and help us is that contact information. And then if you've got a document, how you want that document returned. Do you want it returned regular mail, UPS, FedEx? I would suggest providing that FedEx label and UPS label at the time of submission. Why? We need to know how to get it back to you. And if we are using regular mail, which is fine, just remember there's a different time. There could be a delay in there. And when there's a delay, we get phone calls and emails that say, hey, what happened to the document? So then we reprint the document, we sign the document, we notarize the document, and then we might return the document again. This time, maybe a UPS label or a FedEx label is provided. If you think about that, there's time, there's additional touches to that file. So along with that, when I submit my request, I would also submit that document, completed document, a subordination agreement, assumption agreement, release of guarantee, whatever that document is. Have that done when you submit it. I know some people like to wait till they get the SBA approval, but if you think about it, that's just adding one more touch to that servicing action. By the way, let's remember to get our documents, the subordination agreements and the assumption agreements off SBA's website. Why is that? The legal team recently updated the subordination agreements, and we want to make sure that we're using the correct updated agreement. Now, why would that be? Well, let's think about what's in those subordination agreements. And this goes to the next issue in my submission. I'm submitting an action to the SBA. Let's say it's a non-cash out subordination. What have I looked at in that? What have I submitted? Have I looked at my payoff? Why is that important? Well, within the last week and a half, we've gotten 3 loans, non-cash out subordinations, and lo and behold, what is included in the subordination but prepayment penalties? Now, if I look at my subordination agreement, item 12 in the subordination agreement says we don't subordinate to prepayment penalties. So I'm going to submit my request. I'm going to do my outline. I'm going to get my documents done. I'm going to have my return information in there, my phone number and my email address. It's amazing how many of those are not in the system. And then I've got my documents done. I want to think about what's appropriate to upload, get those documents uploaded. We get a lot of documents in. Some of the stuff we get are articles of incorporation, amendment number 1, amendment number 2, amendment number 3. Those are all PDFs. They're all uploaded maybe into Box, and the amount of time it takes to move those things, open them up and to see what they are is a tremendous amount of time. And so what I would say is what is appropriate? If I'm doing a non-cash out subordination, do I need to provide the amendments to the articles of incorporation? Okay. Also, what is being done here? Is there a payoff? Have I reviewed my payoff, and are there prepayment penalties in there? Right? All of these different things create delays. They may even create declines and resubmissions. And what we want to do is be as efficient as possible, especially in this time of transition and new things that are happening within the centers. Think about sending emails off. The last 504 Connect call, one of the gentlemen from the SLPC was mentioning not providing an email or sending an email to multiple different entities and people. And what happens when we do that, if I send that email to servicing and to John and to Bob and to Larry and everybody else in there, then we start having multiple people working on the same thing. So let's narrow that focus down. Now I have a ton more stuff to do, but we're lacking time. So what I would like to do is just end with that and then hand this back to Joel, and we can refer then over to back to Joel and talk to Gary then.
Thank you, John. Well, in the famous words of the Terminator, I'm back. But you'll all be glad to know that my computer just got refreshed with the new software update. That's what happened. Anyhow, thank you, John, for that. Finally, let me introduce to you Assistant Center Director for 504 Liquidation, Gary Wamhoff. Gary.
Thanks so much, Joel. Good afternoon, everybody. My name is Gary Wamhoff. I lead the loan liquidation team here, and thank you for having me. I've only got one slide, so I'm just going to jump right in on it. I am asked on occasion by CDCs and others, how long does it take to do a liquidation? And I'm not talking about the specific liquidation transaction that we might do, like a short sale or paying expenses, but how long does it take to get a resolution on a loan from the date of purchase to one of three things happening? A loan resolution being either the loan pays in full, we return the loan back to regular servicing status, or we have to charge a loan off, and we don't ever want to have to charge a loan off. We like either having them pay in full or be returned back to regular servicing status. That resolution from start to finish, we strive to resolve those in under 365 days. And in many occasions, we do it well under 365 days. And I like to give shout outs to CDCs because we have CDCs that do an amazing job. We just purchased a loan, as an example, on September 1st. And this CDC, it's September 9th here today. This CDC has already sent to us life insurance proceeds. Our borrower was a sole proprietor, and unfortunately, they passed away. And for the deficiency balance, the spouse is going to be mailing us a payment shortly. So we're going to have a resolution on one liquidation case in probably a couple weeks. And then, of course, we have those on the other end of the spectrum as well. We are not above bankruptcy law. We have some states that are judicial foreclosure states with a lengthy redemption rights period. So we do have some liquidation cases that might extend over a year, but that is generally our goal, is to get these loans resolved within 365 days. I just wanted to share with you all briefly some general, again, every liquidation case is unique. They all kind of follow their own path, but I just wanted to share some general liquidation timelines real briefly. You know, when we purchase a debenture, within 30 days, we would like to have a liquidation plan submitted from the CDC. And that's very important to us because sometimes the CDCs may be working with borrowers at the time of debenture purchase on a repayment plan, as an example. The property may be listed for sale, and that's important that SBA knows those things because once we purchase a loan, if our loan is 60 days delinquent, it's automatically going to start the referral process to go to Treasury for offset. And again, if the CDC is doing some sort of workout, we don't want to have that happen. We can flip a switch and keep that from happening. And then at 120 days, when the loan is 120 days delinquent after purchase, then Treasury formally takes it on for offset, looking at, again, Social Security as an example, other government benefits, just offset opportunities. So it is very important that we hear from you all if you do have some sort of a workout pending. You see some of the common liquidation actions. Generally, these liquidation actions, they can start happening anytime after the debenture's purchased, but for sure at around the 90-day interval, we would like to know what's happening with the collateral. Is there a foreclosure going on? What the status might be? And you see some of the common liquidation actions that will pop up during the liquidation process, and we'll talk about them again real briefly here in just a minute. But once our collateral liquidation is complete, or we've decided to abandon the collateral due to a lack of value, then it's time to kind of explore looking at the guarantors for the deficiency balance. Do they have good wealth where maybe we want to pursue a judgment against them? It's a good time to explore offers and compromise with them, perhaps, because some of these 504 loans, I readily acknowledge, they're big dollars right now. Or perhaps we are able to do some sort of a workout plan on that deficiency balance, and sometimes we do. Once all the collection work is done on the 504 and either the loan's fully liquidated or we've made a determination not to liquidate, we then solicit the CDCs to submit a final wrap-up report and, of course, their final CPC care of preservation of collateral expense reports if they have any expenses they would like SBA to reimburse. And then we charge the loan off. Once we're done with everything, if we're not able to get it back to regular servicing status or paid in full, and we have a deficiency balance, we move the loan back on to charge-off status, and Treasury at that point will begin to pursue all of our liable parties. The last thing I just want to point out to you all, if you have not done it, I encourage you all to visit our center website. And the 504 liquidation section has some very, very valuable stuff on it. Any forms that you might want to look at for 504 liquidation, like the liquidation plan, the offer and compromise tabs, the charge-off tabs, the CPC reimbursement tabs, we've talked about all those. They're all on our website. The links all work. I tried most of them out just yesterday, and those links are active and do work. And so I encourage you all to visit our website. I think you'll find something really of value there. And if there's something that you would like to see on our website that is not there, please reach out to me, and I can work with Joel, and we can explore getting that added. So with that, that's all I have for today. Joel, let me turn it back over to you. I think you wanted to close with some comments.
Thank you, Gary, and thank you for the suggestion to visit the website, and thank you also for checking out those links. That's a very valuable add. I would just like to close by saying that we all understand that we live in a metric center world, and we have to manage by the numbers. But I think it is helpful to pause every now and then and consider what is behind those numbers. Earlier, I mentioned that we are performing within expectations by the numbers. John and Gary have shared some ideas with you on how you can help us help you. And that's how we offer all of our suggestions with that in mind. We want to help you in the vital work that you're doing. But I want to share with you just a note that one of our team members received just yesterday. It's from a vice president of a CDC that we get to serve. And this vice president writes, "Thank you so much for all the work you put into this request. Your supervisor is very fortunate to have you on his team. In my 15 years with the CDC, I have never seen a request handled so quickly and efficiently. I truly appreciate your efforts. Help us help you." Just that's the theme of our discussion today, and I do have a favor to ask of all of you. If you ever encounter an idea, a question, or concern, and you have an idea for training, either for your CDC or for our district office friends, training for the district office, would you please let any one of our assistant district center center directors or our deputy center director, Michelle Serrano, know? And then there's me. I would like to hear from you, especially if you feel that we're not getting it right. We want to have the first opportunity of resolving any issue that's on your mind. And with that, we've learned a lot of things over the last several months. But one of the things that we've always appreciated is we truly do enjoy working with all of our CDCs and our district office friends and our program peers within SBA and supporting the work that you're doing. Because together we are building a better America, one 504 loan at a time. So thank you very much for your time, and I'm sorry for the technological glitch, but I'll turn it back to our host. Thank you.
Thank you, Joel. And then last up, we have the Office of Credit Risk Management, and we're going to turn that over to Nermeen Neam. Did I say that correctly?
Perfect. That's all right. Awesome. All right, everyone. Thank you for having me today. My name is Nermeen Ghanem, and I am the Supervisory Financial Analyst in OCRM. First thing we're going to go through is our balance sheet for the 504 as of July 31st. As you guys can see on the screen, the balance sheet trends. Our outstanding gross balance has been steady growing, and it's up by 7% year over year. Our stress loans, though, are up by 31% year over year, something that needs to be monitored and we need to look at. Delinquencies are also up by 38%, a little bit over 38% year over year. This increase suggests also some rising borrower challenges, so something that has to be monitored. Deferred loans up by 25% year over year. That's another category that we have to look at. Though it's a small portion of the portfolio, it's still something that needs to be monitored. Active default rates were up by 33%, largely driven by liquidation, and we jumped over 200% as of July, something that has to be also monitored. Looking at the net cash flow trends, historically, we've had some good peak. However, as of 2022, it has been declining. As you guys can see, for FY 2025, we're at 220 million, which it's lower, of course, than what you see on the screen for prior years. This shows that we need to look at some tracking. We need to see some things and how we can get the cash flow a little bit higher and improving. It's still positive, but it's on a downward, so we have to bring that up a little bit. So some key takeaways from the balance sheet: stress is emerging, and we need to just keep monitoring, especially with delinquencies and liquidations. Next slide. Next thing is we're going to talk about is the CDC annual report guide, something that was announced back in June. We have not gotten a lot of questions about that. I think the report itself and the guide itself has been very helpful. It's very detailed. It's lengthy. It provides a lot of links directly to the CFR, which helps CDCs obtain information if they have any questions or if they need anything. The most important thing, a few questions came across is, should we use this now or can we use the old version? And it tells you right here that if your fiscal year end is on or after the publication of the notice, then you'll use the new one. If it's prior, then you'll use the old one. I put the last bullet point, well, not a bullet, but a statement at the bottom in red, because it's very important for the CDCs to address everything on the annual report. Even if does not apply to you, just put NA 0- something saying that you're acknowledging that section of the report. If we get it back and it's not addressed, it's assumed that it didn't happen or you guys missed it, and that could possibly be a finding. Next. This is a quick snippet of the first page. I didn't want to go through the whole report with you guys all today just for the sake of time. But I just wanted you guys to understand a lot of changes happened. This is a snippet of it. It gives you links to directly to the CFR. It helps you to find and locate items that are necessary to be included in your annual report guide. It also has some information all the way at the end for delegated authority renewals in your lending authorities, and it gives you instructions on what needs to be submitted to us for it to be reviewed. Our oversight activities and risk-based reviews have been going through a major retooling, and OCRM is retooling our templates. And we are working to make it a more transparent and make it consistent across all reviews. So if you are a lender, that's through a Community Advantage 7A, and you're a CDC through 504, everyone is going to see almost the same basic review, but it's just going to be direct to your entity or to your type of lending. It's going to be used as a coaching tool. Our goal is not to make it as just a compliance check, and it's going to be like, okay, here's done, it's done, we're moving on. It's actually going to be a coaching tool. So it's going to help you strengthen your operations. It's going to help you understand trends, what happened with your entity last quarter, prior to quarter, going all the way back to 5 quarters. So we're hoping that review will give you a clear idea of where your entity is going and your CDC is going when it comes to specific metrics on the lender portal. Like I said, hopefully that It's the designation of it is to make it transparent and it be beneficial to both you as well as us. The template is also going to provide, and the desktop review is going to be providing CDCs with guidance on where to find specific things on a report. A lot of times when we issue reports out to CDCs as well as lenders, we are like, where did you get this information from? Well, now it's going to be put in that report for you. So all you have to do is just tell you a link, or it gives you instructions where to find it in the portal. So it's easy for CDCs to access it and understand where we came up with these numbers. Next. So as you guys are all aware, I am the point of contact for 504 as well as Community Advantage. I have a peer who is extremely helpful. His name is Philip with me as well on the Community Advantage side, but I'm going to be mainly your point of contact for anything related to 504. So if you have questions about your SMART review, if you have questions about your ALP renewal, PCLP renewal, anything that has to do with 504, you may direct all your calls or your emails directly to me. And I believe that's it. Yep, that's it for me, Craig. Thank you.
Thank you, Nermeen.
Thank you, Nermeen.
Of course.
So at this point in time, we'll open up the event for questions, and I'll ask anyone that's reviewing the questions if they want to bring up anything from various departments.
John, let me just sort of scroll through and start responding to things that have already been answered. That might be helpful. So there was a little bit of confusion when Steve said noon on the environmental training. So it's 3 Eastern, noon California time. And we did provide the link for the environmental training. Also, too, Bob Carpenter and his team provided the link to the MARC training. So we do have that in the chat. And theirs will be Friday at 2 p.m. Eastern time. We've been asking questions, you know, the modernization plan that Jamie referenced, is there like a published document you can go to? And no, there isn't, but we are making the announcements on the parts of the work plan that we accomplish. We have an SOP notice and clearance now, and that will be published. We have a Federal Register notice that has cleared, that is in the administrator's office for signature, and there are all sorts of pieces that are coming your way, and some parts that require legislative changes. So when you see the legislation change, you'll know that we were successful in advocating that. So we just continue to keep NACO in the loop, and whenever we accomplish something, they are very generous about helping us respond with a TI memo. I don't know if Bob or Dan are still on. Our SBLC CAs authorized to participate in the MARC program. SBLC CA lenders are 7A lenders, and it is a MARC program, which is a 7A product. So I would say please go to Friday's training and reconfirm, but it would appear that they would be. The PIA audits. There was discussion at one of the last conference calls that the OFPO was looking at adjusting the timeframes for PIA audits. All that is done by contract, and with those in-house, we can't just make a contract change without getting authorization well in advance. So it will happen. It just didn't happen as soon as we thought, and we're going through a process to get the contract modified. It's coming. It's been approved. It's just you can't do it immediately. And so they will make an update either on a Connect call or a major NATCO event when that is in place. We did, however, start the notification of the TPLs. That has already started. What's the current time that we should quote new franchises? Thank you, Steve. Well, right now, they're getting around a turnaround time about 10 to 15 business days. And do we need a copy of the franchise certification in our files? And he said, no, you do not need to keep a copy of the franchise certification. So, and again, some other questions. People kept asking for the environmental training link. I just tried to populate that when we saw that. What's the process for analyzing non-franchise management agreements? Once again, thank you, Steve. If the management agreement is not part of the franchise document, the CDC is responsible to review it based on guidance in the SOP. I would say if you get absolutely stumped, your district council is always a wonderful resource. Are there any updates to the alien verification process? I think you're talking about a citizenship notice that's been talked about at a couple of conferences. It was last talked about at the America East Conference. That notice is still in clearance, so we don't have an update at this time, but we are continuing to monitor where that goes through clearance. Obviously, there's a lot of White House discussion with something like that. Can you provide more information on the median package grade? Probably not on this call, but if you will email Peter directly, and his email is right here on the left-hand side of the screen, I think Peter would have more time to respond to you directly on the median package grade calculation. How long does it take to get a payoff from the loan counting department? We don't have anybody from the CFO's office on the call. John Gossett or Gary, do you have a response for that?
You know, we do a purchase like on September 1st. Our Denver Finance Center usually gets the liquidation account set up pretty quick, but not always. Sometimes there might be a little bit of a delay, and if there is a delay for some reason, please reach out to me. Maybe we can come up with some sort of a hybrid number to give a real close estimate, and then when the dust settles, if we need to administratively remove a couple of dollars, we sure can. But Denver generally gets those notes set up pretty quickly after the first of the month. But if there's anything odd going on, please reach out to me, and we'll see if we can come up with something in the interim.
And I don't think Zane is still on the call, but we will forward on to him. If you want to email Zane directly, I don't have Zane's email on this, but if you want to send Greg Siriati an email with the tenants in common question, we'll forward that on to Zane and the team so that they can look to see if there's a coding issue with tenants in common and EPCs. And Joel Steiner, if you're still on, someone thinks you're the best. That's wonderful. It was mentioned that the USCIS INS clearance email box was not working last week. If you have a specific question, just email Peter. You're on. Peter, let me just ask. Peter, do they need to resubmit anything submitted last week, or would that be
no? That's it's two separate things. It was just from us talking to the DHS and getting a response from them. So that has been fixed, and we're just sort of digging ourselves from underneath the mountain of responses we still have to get through. So,
and Nermeen, is there already a recording on the on-demand website for how to use the new annual report guide?
I don't believe so. Actually, no, there is. I'm wrong. There is. We went through that actually last 504 Connect call.
There you go.
Yep,
so
it was done in last 504 Connect call.
There's a recording available on the on-demand website, and see the June Connect call,
and that recording was sent out as well.
And Jerome emailed it to everybody, but Jerome did something else. We had so many new people and so much content. Jerome looked at the timestamp of when each topic ended and which topic began. So when you look at the list on our on-demand site, you'll be able to see at what point in time does the annual report guide training start, and you can click and start the recording, and you can scroll forward using the timestamp, so you don't have to listen to the whole Connect call just to get to that part of the training. So good job, Jerome. See, I'm seeing some ALP Express loans approved in one business day. Peter, take a bow. Wherever you are, stand up and take a bow.
No, thank you.
Congratulations on that. Peter's already been candid with, turn times and staffing challenges. So I'm going to pat it, get him kudos for the one day. And we've already been honest with you about some take longer. And I would say different CDCs and different loan officers within different CDCs do different levels of due diligence in their package. The more they have to dig through to try to understand, the less that's clear, the more times they have to reach back out to the CDC, the longer that it takes. The more quality control check you do before you ever submit it, the shorter the turn time. So next is a question for Nermeen. Is the SMART review contractor selected yet? And if so, when would SMART reviews resume? And I don't even know if we're allowed to comment on that yet.
Yes, Linda, not yet. We're not going to talk about this right now. Yep.
Okay. And that's just, we understand the curiosity, but we're learning as well.
It's work in progress.
Exactly. Will there be a blanket extension for the audit requirement deadline? So I don't know that they've thought that through. So I'll just kind of say, we'll take your question back to management, and if there are any discussions of something like that, I'm sure they'll reach out to NEDCO to help communicate it. So that's kind of the inbox that we have. We got 5 new ones, 6 new ones. Okay, we only have like time for about 3 or 4 more questions, and then we're gonna have to go. My favorite question: will you send out the slide deck? Yes, we do have to make it 508 compliant first and check the recording, but yes, we always send it out. Any suggestions about getting a 4363 resolution cleared? Send me that one offline. I don't know who it came from. It's anonymous, so we can try to drill down to see what's causing your 4363. There are different things that can cause it, and until we know more specifics, I don't really know where to route it, but email me directly and we'll see what we can do to help you. Is there an additional, let's see, the non-bank, the banking, Dan referenced this, and this is on the, I'll go ahead and publish this one. The subordination process will go back to OFPO on that one, and the Connect call will be published. So let me go back to the published site. So, hold on. The 2 new ones that just came in. Is there any additional guidance on the debanking certifications? No. Dan referenced that during his discussions. There is the email that's in our slide. Just send all questions to that email box. And will the Connect call be posted? Yes, Jerome always posts it. He puts it on the on-demand website, and he circulates it by blast email, so it goes to everyone that's on our subscriber list. So question for the servicing center, and this will be our last question of the day. Has the UCC idle subordination request process changed lately?
Linda, this is John Gossett. Let me answer that. That's the UCC idle subordination. Now, here's the key to that idle subordination. There is an application for subordination that needs to be submitted to idle. Now, the problem is that the banks and CDCs, they're putting the wrong loan number in field 3. So there's a bunch of fields you need to fill out. Field 3 says loan number. Idle wants the idle loan number there. So if you're a 7A lender or a CDC and you put in your loan number there, as an example, you're telling idle, hey, we would like you to subordinate your UCCs to ours, and you put your loan number there, what idle is going to do is they're going to see that loan number, turn around and send it to Fresno. And then we're going to have to turn around and figure out what's going on and send it back to idle. So the key to that, when you complete that application, make sure you have the idle loan number, the disaster loan number. Now, here's a couple of helpful hints on that. If you go into eTran, the servicing page of your loan, you look for other loans to borrower. There's a section in there, it's a yellow and white section that says other loans to borrower. Look at that and look, and if you see DCI, that tells you that's a disaster loan. That's the loan number. Your borrower can also go to My SBA portal and find their disaster loan number that way. But I probably send one of these a day back to disaster that have been sent to us because it's got the wrong loan number on it. And so I'm actually calling banks, things like that, saying, hey, when you do this, make sure you're putting the disaster loan number there, because that is a big delay. And there's one that's gone back and forth to multiple different offices. and I stepped into it, and we got it worked out. The key to that is the application. Also, pull your UCC filing. And if it says SBA El Paso or SBA Birmingham, you know that's the correct UCC filing for the disaster loan. So put those two things together and make sure you are getting the disaster loan on field 3 on the disaster loan application for subordination. Otherwise, if you put the wrong loan number on there, if you ask the borrower, and you're a 504 lender and you ask the borrower, they give you the 7A loan, it's gonna go in a big circle. So that's the key to that. Everything else I think follows the same. I'm in communication with disaster on these almost every day. So thank you guys very much. I hope that was helpful.
Those are great
John,
details.
that was a wonderful answer. That was a wonderful answer. That's going to help us a lot more during the Q&A. Well, I think that it's 4:30. Everyone's been very generous with their time as presenters, as an audience. We started out with almost 1,300, and now we're down to about 800. So it sounds like most people stayed with us the most of the day and found value in what we were sharing. So we thank you for your time and your effort and for all that you do in your community every day to help us get to the next best place in helping your small business for borrower. Our next call will be December 9th, but in the meantime, we've got Flagel, and then we've got the NACO conference in October. So thanks for joining us remotely. We look forward to seeing many of you in person, and we'll give you back the balance of your day. And thanks again for all you do for our communities.